Welcome to the Sparky Coach podcast. This platform was built by Sparkies for Sparkies. We simply exist to make business owners more profitable, or businesses more profitable and more predictable. So we want to work with people that work hard because we love working hard too, that work smart because you got to be on top of the business, people that are kind because no one likes a dickhead. Am I right? People who want results because that's what we're here for, right? And people who want to be part of a like-minded community. So if you're interested in hearing more about the platform, please reach out and enjoy the podcast.
Sparky Coach Pod. Got Cam here, and we've got the accounting extraordinaire, Angela Lee, with me from Codification. Welcome along, Ange.
Hello, thanks for having me.
No worries at all. So we've got a little lounge session in progress now. We're going to be having a little bit of a look and a discussion around end of financial year because it is coming up in about a month's time, and it is better to be ahead of the game or ahead of the 8 ball than behind, which we will dive into and have a little bit of a look into. But I guess probably two sort of areas that we will jump into, which we have talked about in the past previously, but obviously needs to be taken into consideration at this particular time of year, is there's probably two things you're looking at to do when you're looking at doing a little bit of planning towards the end of the financial year. And that's around, hey, what are we looking at in regard to potentially looking at what do we want to pay in our tax side of things? And are we looking at minimizing it to a point of view, or are we actually looking at getting some kind of financing or funding into the future as well, because you cannot get finance on hopes and dreams. You actually need real hard data and real hard numbers. So that's probably the two areas that I want to dive into first, Ange, is the considerations that we need to have a look at when we're just getting a little bit of a strategy together before June 30. I mind you, we need to do this before June 30. It's a bit hard afterwards, particularly if you need to move some money around, so to speak, or get money through some, like for example, the super clearinghouse, like it needs to be gone, sent, delivered, landed. So, Ange, I'll pass over to you there. The sort of considerations, I guess, that we want to take into account moving around the end of financial year.
Yep, cool. Well, first and foremost, you need to have your accounting software all nice and squeaky clean so you actually know that you're looking at the current numbers. So obviously that entails reconciling everything, getting a handle on your accounts receivable too, and where's that up to, because there's opportunities to write off bad debt. Not that we, if you have bad debt, then that's a whole nother conversation, but let's hope not too many people have that going on.
I think on the bad debt side of it, Ange, I think it's an acknowledgement of it and understanding around it too. Like, so we obviously don't want it and we want to minimize it, but I think it's probably fair to say there's no one who has run an electrical business who hasn't unfortunately had to encounter a bad debt through a number of channels. Of course, you could have had someone go belly up, worst case scenario, or it could have just been a poorly communicated job that got done by all parties, or someone could have ghosted you, so to speak. So I think the one thing, I know we've talked about this a little bit in the past, and is like the acknowledgement of it. Like, so actually it's an opportunity to acknowledge it, because you can, if you are chasing it down, you can still be paid for it and it can still be then dealt with down the track as well, but just acknowledging it at this time of year.
Absolutely. Yep. Yeah, just 100% get your records, knowing who owes you money at every single point in time, and that should be on a daily basis as well. So yeah, it's a good touch point to say this is very important, particularly for cash flow and everything else. So yes, bad debt is going to happen for sure, and it's a good learning curve for everyone to go through, I guess. It's an eye-opener, that's for sure. Also cleaning up your accounts payable in your accounting software. So know who you owe money to, and then if there's things in there that have already been paid, that's obviously going to influence your numbers and add extra things to your P&L. So you think you're doing you got less tax than you actually do because that's contributing.
Yes.
So once you're confident that everything is, but your zero file is telling you the truth, then you can look at your profits and then sort of go from there. So reach out to your accountant and just say, do your off tax planning, and then they can help you along the way. But I guess the points that I'm going to go through next are more like what you can do to increase your profits for the finance, like you said before, or get that tax savings. So we'll start with the improving your profits to begin with. Selling assets is probably one of the things that could increase your taxable profit, but could not, depending on the small business pool and where you're up to with that. But essentially, this day and age, it's pretty rare to have a car that you've bought, 2 years ago to still have depreciation going onto it because of the small business write-off pool rules. So if you do sell an asset, it's most likely going to be assessable income. And that's obviously if you don't need a car anymore, if you don't need any tools that you're using, sell them, that'll increase your income. Your June bills, so you could pause some of your bills if you go through all your expenses, make sure that you're paying for everything you need to and not anything you don't. So yeah, cutting costs is obviously going to increase your profits. Stock take, this is a very rare one, but if you're a business who does have a lot of stock, you can go through and see the value of everything that's sitting on your shelves, and then it can be backed out as a closing stock. So it essentially gets removed from your profit and loss and goes on your balance sheet as an asset. So yeah, if you're holding a lot of stock, that's a good way to increase it. It's obviously going to come back around next year because you're going to bring back all those assets that are sitting on your shelf as a cost into your business. So yeah, just sort of moving it from one year to the other, I guess. It's not a bad thing to do, actually, just to stop and do a stock take anyway, because a lot of
100%.
people aren't quite aware what they got sitting on the shelf, and it literally is just cash sitting on the shelf. So yeah.
Well, I think the stock take side of things is particularly important, depending on the type of work that you're doing, first and foremost. So obviously, if you're a bit more regionally based, you might not have access to the same supply chains that you would have
Yeah.
in the metropolitan area. So you may need to be carrying a fair bit of stock to be able to operate. And then I would also say other companies that operate in particularly the solar space, they generally, for a competitive edge, so to speak, and then also from a serviceability point of view, they often buy in bulk. So buying pallets of panels, buying pallets of batteries, pallets of racking, et cetera, et cetera. It gives you the ability to get at a better purchase price, but also control your installation requirements as opposed to being at the mercy of the supply chain sort of thing. If you're using a job management software like Simpro, for example, it has just the stock take built into it. So you can literally go through, and if you are purchasing correctly in an ideal world and using purchase orders, et cetera, it will come through and it feeds through on the back end, and it creates basically a full catalog stock take of all the items that you've purchased. Then as they get allocated onto jobs, it depletes them. So you're getting items coming in and items going out. If you haven't done that, it's also okay. But what it gives you the ability to do is you can do an adjustment on there to be like, hey, these are the actual. So you go through, count out what you have in your warehouse, what you have in the vehicles, et cetera, and gives you the ability to then, it tells you the value of the items that you have on hand. And then you can also be aware of what you have. It's a great opportunity. And I really encourage everyone, if you haven't done it before, at least get to do it and go through the vehicles at least for a start. You would be extremely surprised the amount of stuff, and I'm going to put inverted commas on stuff because it quite literally is stuff that is worth money, however, sitting in the vans. But I think you would be extremely surprised the amount that is in there. So I was chatting to one of the boys the other week, it's probably a few months ago now, and he was like, "Yeah, I've never done that. I'm going to jump onto it." They found nine digital dimmers. So that cost is about $110 from a project that was done about 12 to 18 months ago that never got returned. So look, let's call it, let's square it out. Let's just say, so there's $1,000 just sitting in a vehicle that no one really knew about.
Yeah,
Now,
right.
that if you had $1,000 in cash, you would not just be letting it sit on a shelf, so to
Yeah.
speak. But that's essentially what has occurred. And I've spoken to a number of guys around this lately, and I've just been a bit more encouraging around it because it allows you to get an understanding of the value of that car. So you can pull up vehicle X, for example, registration, 123 ABC, and it will be like the value in this car is $4,000. And what you'll start to get is you'll recognize a trend and you'll recognize what you actually feel comfortable with as well, to be like, oh, well, hey, that's okay. That car, that's our service vehicle. So it does a lot of our service and maintenance style work. So it needs to carry a little bit more. Then you may have the, underground ute or underground vehicle that you use. And you're like, why has it got so much money in it? When really it's probably more just a vehicle that's used for toolage and getting around and actually completing the task and a bit of heavy lifting. So I strongly encourage you. It's really eye-opening. And touching on that, one of the fellow I was speaking to with the 9 dimmers, they were then able to pull everything out of the vehicles that weren't needed. They kept it in the warehouse, and then they were able to distribute it out to the jobs that were upcoming. And I'm pretty sure, off the top of my head, the last conversation we had that he was up. So they were down $10,000 on their monthly average spend at suppliers just by doing. I think it ran for 2 months on that. So they were down because they were utilizing the stock of materials that they already had, and they were also what it did was it made them more aware of what they were actually purchasing as well at the suppliers. So they became a little bit more savvy and a little bit more on top of that. So it is essentially your liquidity tied up in material as well. So it's quite literally cash sitting on the shelf. So if you don't need to, if the way you're operating your business, if it doesn't need to be done like that, particularly most metropolitan areas, like you can literally buy same day. So you're literally just doing a transaction each day. So strongly encourage you to get around it. It's really eye-opening and get an understanding of what you do have. It does also really help to be aware, because then it's like, oh, hey, we can use this for this job and we can use this here. And what it does is it gets the material out of the warehouse and out of the vehicles and onto the jobs where it should be going. So
And like you said, it's pure profit because you've already purchased those materials that are going into future jobs. So yeah, no, absolutely. That's a great opportunity to then, if you're not doing it in Simpro, get your figures and then implement them, and then you're off and running. So you've got a running inventory. Yep. No, that's great. Love it. Yep. Perfect.
So get onto it if you get a chance. Recommend it. Right, where are we up to now? I hijacked that, Ange.
No, it's good. Good. I know it's tedious, but you'll feel so much better once it's done.
And I think probably like it's the small things that have a big impact. So it might seem like a tedious exercise. Oh, I don't want to do that. But I think you'd be really like, I would guarantee that 95% of people would be quite literally blown away with the value that's there. They would be like, oh, wow. I think when we did one a few years ago, or a couple of years ago, I think we found like 6 or 7 drums of 6 mil cable. So, they're probably, I think it was about $300 a roll at the time. And the usage on a job, if you're doing a residential rough-in, you might be doing the oven and the hot plates. And if the AC circuit's a 32 single, you might be doing a couple of them. So you're not even going through a drum on a job. And so it's just accumulating. And I was like, what do we have all this cable for that we're like not going to be, like, it's not something we would use every single day. And it starts to add up. So it makes you more aware of what you do have and what you don't have, and how you go about using it. So yeah,
I guess
worthwhile.
Also on that point, it's a good conversation to have with the staff as well, to make them sort of accountable and build it into their KPIs going, you've got to keep your stock really tight in your own van. And because, yeah, if they understand the value of it, then they can really understand that if you don't need it, you've got to go get a credit note for it. You can't just shove it in the shelf on the van and then completely forget about it. So,
Yep.
yeah,
Just get a bit
good
more
call.
aware. I think if you bring awareness to anything, it's great.
Yeah. Yeah. All right. So yeah, improving profits. Any scrap metal lying around, take to the yard, get some money in for that. And then the obvious one is just go hard with your jobs. Like just book your schedule out. I mean, if the work's there, then you're trying to get the profits up, just go, super hard. So, if you did that, as long as with your stock take and using up the supplies you've got, your profits will, really blow out. And then I guess it's a fine line between not improving them too much because then the tax implications come in. So if you are going for finance, obviously chat to a broker or the bank and sort of try and get an idea of what they're after and aim for that. So yeah, improving profits. All right, so I guess we'll talk about tax savings now. So you've had a great year. You're pretty daunted about the amount of tax that is heading your way. So these are the things that you can implement before 30 June to sort of minimize it. And just remember, a lot of these are kicking the can down the road. So whatever you do this year could affect next year. So just, be aware of that. Some are instant deductions, so that's all good. All right, so probably no secret by now that I am a big advocate for putting money into super. So I guess this is the cash needs to be available for this one. So if you are running on a tight cash flow schedule at the minute, probably not the best option. But you contribute into super, instant deduction for the business, and you pay 15% over in the super fund. So you've got a cap of 30,000 contribution for this year. But then there's also some carried forward caps that you can use up to if you did want to go harder with that. But you have to check how much you've put in year to date, because that 30,000 isn't just a once off. You've got to take into consideration what you've got through your wages already and take that off. So
So $30,000 is the maximum amount you can contribute in a calendar financial year.
Yeah.
So if you've already paid, for example, say you've got your PAYG each week, it's occurring, taking superannuation out of that each week. Let's just say you've already contributed, $15,000, for example, over the year. That gives you've got $15,000 left.
Correct. Yeah.
Cool.
The ATO portal, in your MyGov section, it has a super section that kind of keeps track of that semi well. So you can check that out and see where you're up to.
What about on the superannuation side of things too, Ange, where you can go back in time, so to speak, with the carry? Do you want to just explain that?
Yeah, so there's a unused contribution cap available. It's a 5-year block. So if you haven't gone to your maximum, and the maximums have changed over those 5 years, I think it was 25,000, 27,500, 30,000. So all those caps combined, you add them up for the 5 years. You see what you've contributed over those 5 years, and the difference you can pop in one full financial year to get you maximized for those 5 years on all your caps. Massive incentives there. But again, the cash has to be available for that. And also, you have to be in a mindset that you don't want that cash, or you don't want to invest that outside of super, because we all know once it goes into super, it's locked. You can't access it until you retire. So,
yes.
Yeah. So it's got to align with your goals, obviously. You've got to have the cash available. And if you're someone who's wanting to eventually buy a commercial property in a self-managed super fund, so have the property in a self-managed super fund and then your business rents it from the super fund, the maximizing your caps is the best way to increase that in order for you to reach that goal.
Mhm.
So
For the record, it was $27,500 from 21-22 year up until 24-25, and then that's when it rose to 30,000. So we're currently at 30, and then next year, the 26-27 year, will go to $32,500. So that's the cap.
yeah.
So yeah. So for example, if over the last 5 years, for example, you only put in $15,000 in the 21, 22 to 23, 24 years, you've got space to put in about $12,500 that can be carried forward over to 12.5 times 3 plus whatever you didn't do last year. So it can be a significant whack, particularly if you've been extremely profitable, and you've got some. It's a legal way it's 100% legal way to do it, to get to offset some of your profit.
Yep. And your future self will thank you for it.
Nice.
All right. So we'll come back to employee super because of payday super. So we'll get to that.
Yes.
Staff bonuses, I guess. Just take check. Is anyone doing a fantastic job that they need a bonus? Extra tax deduction there. Keep the staff happy. Check everyone's on the right pay rate. If they need back pay for any reason, get that sorted. You could have a mid-year party, but I guess the things with the parties are that if you have them on your premises and you bring food in and do a training session and all that, that's tax deductible. But as soon as you take them to a restaurant or an activity, then FBT comes into play too. So yeah, if you are scheduled to have a team get together, you can chuck one of those in the mix, but just have them on your premises and chuck in some staff training there as well. All right, the asset write-off. I'm so happy that the budget actually addressed this because we have so much clarity around this now. It's very uncertain. So the instant asset write-offs for assets under $20,000 is going to continue indefinitely.
Yes.
So
which is great.
Yep. Yes, amazing. And then the small business pool is still available as well. So first year you get 15,000. If an asset is over 20,000, it goes into a pool and you get 15% on the first year and then 30% after that. So yeah, it's a good win because it's been dangling for years and years that they're going to take that away, and it just kept getting extended. But yeah, now we're in this situation where it's blanket, it's continuing. Happy days.
Which is good because I think they bought it in about 5 years ago, something like that, or maybe around COVID-ish, or maybe longer.
No, I think it's been going on for longer than that. I think maybe 12 years. And then there was that whole full depreciation somewhere in the yeah.
Anyway, that's all right. It's here for good, which is good.
Yes, happy days. Okay, so paying creditors. This I guess it depends if you're running off an accrual or a cash reporting basis, but you can also bring forward rent payments if you wanted to prepay them. Prepay anyone basically, as long as there's an invoice to go with it. You could potentially defer client invoices, but again, this is a bit tricky because it does go off when you've earned the income. So could be going into unfavorable territory if you got audited. But yeah, if you can't get the job finished by 30 June, then the invoice goes into next year. And then you need to turn the spotlight onto your wages as a director or an owner or whatever the structure is. Are you taking the right amount of wages compared to the entity's profits? Is it worth you increasing that, decreasing, whatever the case may be? Because with all this super and STP and all this, it's kind of a thing of the past where you can just wait till you do your tax return to make sure you got it right. So it's probably going to be more important than ever moving forward that we get these wages sort of in a really structured environment. And then before 30 June, we do that analysis and adjust it that way. So yeah, just check your profits, check where your wages are. The marginal tax rate is obviously going to be heavily dependent on this, and then whatever entity you're operating in. If it makes sense, then yeah, obviously don't touch it. If it doesn't, then the wages can be posted and the money doesn't necessarily have to be paid or refunded, whatever the case may be. It can be fed through your loan account on the balance sheet. So yeah, that's the generalized ones anyway. I'm sure there's multiple more out there depending on your situation. But yeah, let's have a chat about payday super.
Yeah.
That's coming up.
Payday super kicking in July 1.
Yes.
So obviously, yeah, traditionally super's been paid in arrears, so to speak, is the easiest way. So it gets accrued over the quarter and then gets dumped in a lump sum, basically through a clearinghouse. That is a thing of the past. It will now need to be paid each week, or basically with the pay run, so to speak. So whenever the wages are being paid, the super contribution will also need to be paid too. So in real layman's terms, that's what's occurring. But Angie, do you want to elaborate on it and sort of, I guess, the pros and cons to it, I guess, because there are benefits to it. But obviously it could, some people may see it as a negative, but just interested to, if you can elaborate on that.
Yep. Okay, cool. Well, it's obviously going to hurt cash flow wise as a major negative, because if people have been using that super to float operating expenses and then sort of scramble towards the end to get that quarterly bulk payment sorted, it's going to really hurt when you've got your June quarter and then you start paying your weeklies. So do whatever you can now to get a buffer into an account somewhere to put away to make sure you're 3 weeks, 4 weeks in front with your super, as well as trying to cover your June quarter. There was a little uncertainty about the June quarter and the timing that it needed to be sorted out. So I think I've finally got an answer that because there was talk that if you pay your June in the 28th of July, that the weeklies that you're paying will contribute to your June and therefore make your weeklies late. I think I've got confirmation that the ATO are going to pop resources into looking into this. So it's a fairly new system. They're going to give everyone a bit of leeway. So it's okay to then start paying your weeklies or your fortnightlies, whatever the payroll is, on payday. And then as long as your June quarter is done by the 28th of July, then you're okay. You square up June quarter, you keep up with your current ones, everybody moves on.
Cool.
So takes a bit of pressure off, but from a tax point of view, the June super is not going to be a tax deductible until it's paid. So if you're trying to reduce your taxable income, it might be worth just to sort that June payment out early.
Yeah.
Draw that line in the sand and then start fresh on the new year.
Okay. Perfect. Clear as mud. I'm sure that's clear as mud for everyone. No. A bit of a change there, obviously.
Yeah. And timing all matters with this. So you've got You've got 7 days for it to find the super fund after you make payment to the employees. So payday, basically.
Yep.
So we all know that the clearinghouses take a little bit of time to get through the system and process them. So even though you think you've got 7 days, technically you need to just do it on your payday just to ensure that you get over that processing time.
Yeah, cool. And
Uh,
then your accounting software will be set up to be able to facilitate that in a similar way
yeah,
that it's obviously been getting done in the past.
should be all up and running now. You'll notice when you go post a pay run, it'll say pay employees and pay super.
Mhm.
If you click on that pay super, it'll take you to another page where basically you just tick that pay run, approve it, a text message code will be sent to you, and then they just take the money out of the bank account.
Yep, as per normal. So yeah,
Yeah,
smaller amounts more often is probably an easy way to look
yeah,
at it.
yeah. Yeah, and honestly, in the long run, it is going to be a good thing. It'll give you a lot more clarity of where you're up to with cash flow. Um, I am suspecting that the PYG withholding is going to come into this regime at some point in time. So we're eventually going to be just pushing our gross wages out the door every pay run. So yeah, PYG withholding still that quarterly or monthly, depending on the cycle you're in.
Mhm.
So, and if you're not putting that money away already, suggest you get on that bandwagon as well. So just treat it as if you're paying the ATO on that payday as well for the
Hey,
PYG
so
with.
just on that, Ange, in regards to you know, essentially creating a second bank account within the business that you're putting money aside to each week, so you're able to, cover your essentially tax obligations, so to speak. Is there not a magic number or so, but is there like a percentage guide that you could work off each week of like what you should be going? Well, so let's just say we're turning over $25,000 a week, so to speak, which on average is about $100,000 a month. I know it's not quite exactly that, but I was going to work in round numbers because it makes things easy. Um, is there sort of, obviously you've got your GST component, which is 10% of
Yep.
of that. Is there what sort of percentage, just in a round sense? I know it's a guide sort of thing, but is there like, hey, if I'm doing 25 grand a week, obviously I've got a GST component for that, and then what other percentage should I be throwing across roughly?
Yeah. You can just for simplicity's sake go with the 10%.
Hmm.
You're not going to be paying 10% on your BAS because you've got your expenses that get credited off that. But as a safe, simple way, just do the 10% for the GST.
Okay.
It's not going to hurt. You're going to have leftover savings there, but you could also have the flow, I guess, of saying, get your BAS paid, what's left, you can pop that into a profit account or something like that.
Hmm.
So, yeah, 10% is not going to hurt. It's easy to calculate, done in there. Your PYG withholding, that'll show on your payroll posting. So that'll be a really clear number that you know you can put that away. For tax, it obviously depends what entity you're operating in.
Yeah.
Companies, pretty easy. You could go 25% of what the profit number's telling you. But again, we've got things like the small business pool that affect, do that tax rec adjustment. But just to even just get started, just do 25% in your
Yeah.
profits. Again,
Okay.
not going to hurt. You're not going to go above that 25%. So you're safeguarding yourself
Yeah.
regardless.
Cool.
Yeah. And then, yeah,
Nice.
happy days, you've got leftover money left that you didn't really know that you had if it does end up being less than that. So that's a win in itself.
Hmm. Yeah, nice. No, so definitely, if you're not doing it currently, definitely encourage you to put the money aside at a bare minimum if you're just doing the GST side of like a 10% side of, so you've got at
Yep.
least some money put aside there to cover off
Mm.
the BAS payments that you've got, which are quarterly. And then I think, like you said, Ange, too, is that there is potential for, like, obviously we go on payday super now. There is a potential down the track that it may also go to a weekly sort of cycle as well. So I think the earlier you get into some good habits around things and sort of, I guess, treating, I don't want to call it like surplus because it's not really a surplus amount of cash, but if you're putting a contribution aside to make sure you're covered, and if it is higher than what it is, like, it's a really good habit to get into, because I think you can get really carried away to be like, geez, we've got $200,000 in the bank account, and it's like, yeah, but that's just the cash balance. You've still got to pay this. You've still got to pay this. You've still got to pay this. So just getting an understanding of what your obligations are, and there. I think the key around this too is that as the director of the business, that you're actually responsible for this as well. So, like, I don't want to be, I don't want to come across as like hyperbolic or anything like that. But ultimately, at the end of the day, if you miss your tax obligation, so your BAS payments, you miss your superannuation or anything like that, you're as the director, you'll be held personally responsible for it, which then can stem on and affect you in other ways in your business, well, personal life as well, essentially, because they'll do whatever they can to claw back, obviously, the money that's needed there. So it just because you have it set up in particular ways, you as the director are still obliged.
That's such a good point. Yeah, 100%. And director penalty notices is the name of what the ATO issue you to put you personally liable for the GST and PYG and super. So we have seen an increase of them getting issued. The turnaround time as well on those is super tight. I think it's 21 days for you to act. So yeah, if you're not in a position to do any of that, it's a really scary situation to be in, because this essentially brings in your family home, your family assets, and everything like that. So yeah, the better you can set yourself up to completely avoid that, the better you're going to be in.
100%. And just being aware of that, like, that's where the obligations and consequences can come into it. I think being on top of it too as well, so don't ignore it, because I would say that they can be quite accommodating in the scheme of things if you take ownership of it. Whereas if you just ignore it and basically throw the notices in the bin, they can be quite heavy-handed, and they are probably a way to describe it, Ange, because I know we've talked about in the past, is sort of like they just don't really tolerate it much at the moment anymore. In the last probably 12 to 18 months, it's sort of, they're probably a bit flippant on it for a long time, but they've come down pretty hard on it. So the difference between acknowledging it and then ignoring it, we're talking like it's streets apart.
Yeah, they've completely flipped on the COVID days, and they're trying to undo all the handouts and everything they did in the past. So yes, definitely something you don't want to mess around with, put it that way. Should we talk about budget updates now?
Yeah, definitely. We could have a look into the side of what's happening in the budget. So obviously the budget came out last week. Massive event, obviously. I'm sure everyone got around it. But so obviously a couple of things came out of it that we'll dive into and chat about. Probably the key though is none of this is actually in law, like legislated as such. It's all it's the proposed like framework and ideas that they've come up with that they want to implement into law and legislation. These can traditionally take a while. Like, I'm talking like it can take 12 months or more. So like it may take a long period of time to actually be passed through Parliament, and then even when they actually come into act is in the future as well. So like some of these things might not affect anyone for the next couple of years, but I think it is worth noting a couple of things that came into effect. So probably the biggest impact I think that probably we'll feel as business owners is the change that they brought into effect around the tax rate of 30% on all trusts,
Yeah.
so to speak. And so, and do you want to sort of dive into that a little bit more? And I mean, not to raise alarm bells, but probably just bring awareness to it all, because, like we said, there's nothing legislated yet around it all. It was all just proposed. Bearing in mind, though, the government at the moment, they still have this is only their second budget of a 4-year term, so they still have 2 years to run. So
Yep.
these changes are highly likely to come into effect because they obviously have the majority across the board, not to get all political on everyone, but they're highly likely to come into effect. So I think we need to be aware of them and then what implications or what, I guess, not so much safeguards, but what can be or needs to be done to be able to, not that we want to counteract them, but in essence, we want to counteract them if they are going to affect us in a negative way.
Yeah, that's right. Yeah. And we do have, I think it's May 28, we've got another election. And then this trust, particularly, we'll just talk about the trust, I think, today, because the rest is widely discussed in the media.
Yeah.
But yeah, trusts in particular, they're not kicking in until the 1st of July 2028. So
Yeah.
anything, like as Cam said, anything can happen. Nobody panic. Nobody jump tomorrow and go change structures, because anything can happen is basically the message here. So to understand what implications this could have on everyone, it just basically they're trying to push out trusts in general as a entity structure. So 30% minimum is what the profits on the trusts are going to face. And then that trust distribution still needs to go as normal to somebody, an individual, another entity. But then the term franking credits, I guess, has come into here, for lack of a better word. I think everyone is calling them franking credits. So from what I gather, the trust is going to pay the tax at 30%. And then when it gets distributed down to whoever the beneficiaries are, they're going to get a credit for that tax already paid. The kicker, I guess, is that it's not going to be refundable like franking credits are. So yeah, you could end up paying 30% in the trust, but then you end up being at a 25% marginal, like an average tax rate. You're not going to get that 5% back in your personal name. It's also going to stop people distributing to a bucket company from a trust, because bucket companies aren't going to get or any companies, I guess, I shouldn't just call them bucket companies. The company who gets a trust distribution is not going to get that franking credit. I'll just call it a franking credit because I think everyone understands what that means. So
can I maybe just explain what that means quickly, if someone doesn't understand what the franking credit means?
So the simplest way I can explain it is to avoid double tax being paid. So the money that has in a company has already been taxed on its profits. The shareholder takes profits out, and that profit needs to be declared in the shareholder's taxable income. So in order for them not to pay tax on that already taxed money, they get credits for the money the tax has already been paid. So yeah, not paying tax on that twice. If you above the 25%, then you got to pay the top-up tax, but you're not paying the 25% again.
Hopefully that makes sense. It's essentially, so you don't pay it twice, basically.
Yeah.
Is the easiest way to probably understand it, so to speak.
Yeah.
Sorry,
but yeah,
continue on.
That's right. Companies don't get use of these credits. So if you distributed from a trust to a company, if these laws do get over, the company's going to end up paying 60%, which no one's doing that. So yeah, it's a slap. Unless you're making, huge amounts of money, and that's the most economical way. But I can't see a
I
world where
can't see
anyone
anyone doing it, to be honest.
No, no. So yes, that's the death of bucket companies if this does happen. I guess with all this, it's worth noting that there is going to be rollover relief to restructure. So let's say the trust it's not going to be economical to run in a trust anymore because 30% is going to be above what you're normally getting in your marginal tax rate. You can restructure. There's rollover relief, so you don't pay any capital gains on, moving the business from there to here. And so that's one great thing. I guess the cost of the entity setup is obviously not going to be subsidized. So that's going to land straight on the business owner. The admin that comes along with it is going to be quite heavy. But we've got time. We've got time to work through all this. And yeah, like we said before, maybe not even going to get through law. And then there could be some situations where this is going to be actually really good for some people. I think the maths that was worked out is 230,000 of trust distributions will get the individual to that 30%. So if you've got a trust that's doing over that and it's sending it to an individual, makes sense for you maybe to stay in the trust. So yeah, it's not going to apply to everybody, but I guess it's like the whole awareness thing at this stage. That's all you got to know is just be aware changes potentially are coming. And then just, question. So any new business venture that you want to do between now and when these laws are going to be implemented, it's going to be a bit tricky to understand or advise on what you should do. But if you do get it wrong or you need to restructure for whatever reason, there's options available.
Yeah, so I think main thing is like bringing awareness to it all. I think if you're not sure how you set up, become aware. So ask the question. So ask your accountant the question or have a dig into how the structure is that you have set up currently. I know it can probably seem overwhelming and confusing, obviously, sometimes for people, but I think just take it like anything, just be interested in it. So get interested in it. So have an understanding of how you're set up. Because obviously with the rollover opportunity as well, so the rollover meaning that there's obviously no capital gains will apply. So what that means is basically if you need to restructure, generally speaking, you're changing the way the structure is. More than likely for a tax benefit is the way in their eyes that they've seen it in the past. So then a capital gains they would have to value what you have on the go now, and then there would be a capital gain that does apply to it potentially. So I think just be aware of it so that because it could be being aware of it gives you the opportunity so you don't get caught out down the track as well, and just have an understanding of what you're doing at the moment. Because also to the understanding and awareness gives you the ability to make better decisions as a business owner as well. So it could be the way that you're set up, maybe impacting the way that you do your PAYG or do any sort of distributions currently as well, or potentially into the future. So just being aware of what that impact has. And I know when we all probably go out and start in business is that it's all probably pretty low key and pretty hey, I'm just going to be a Sparky. I'm just going to, go out there and, do my thing. And you probably don't put too much thought on it. But as things start to go along and they gradually improve and you become a more profitable business, that these sorts of things do start to become an impactful event as you look to obviously distribute money around to yourself, not only yourself, but to anyone else working within the business as well. But then also then when you look to do what are we going to be doing with our profits as well? How are we going to distribute them, or how do they get distributed out? So that you do it in a way that is beneficial. And that's probably the way. I don't like to use the word minimizing tax, so to speak, because I think at the end of the day, if you are paying tax, that's actually a positive because it means that you're making money, right? So it is actually a really good thing. I think that you want to just be doing it in a really beneficial way that works best for the way you're set up, and the way that you're operating in your life and in your family and all those sorts of bits and pieces. So just if you're not sure, just get around and get aware of how you're going so that you can make informed decisions.
Yeah. Yeah, it's all about not paying too much tax. Not paying any more tax than you have to because you're in the wrong entity. Yeah. And just on that trust thing as well, it could, because if you're just taking trust distributions without a wage or anything like that, then you're not going to get the tax-free threshold anymore. It's just going to be 30%. But if you wanted to structure it so you take the wage is obviously going to help with the tax-free threshold, eats away the trust distributions. So it might make sense for you to do it that way and keep yourself in the trust, pay your wages up to that 30%, and then, etc. So
reading between the lines of it all, it's it's essentially, and I mean, you can read the headlines and the grabs and all that sort of stuff, but it's essentially an equalization is what there's sort of a few narratives around it all, and sort of basically what they're trying to push towards is that everyone is paying essentially their fair share of PAYG is probably like the most simplistic way to look at it. You can read a lot more. There's lots of commentary and lots of conversation going around this. There's a lot, I guess if you're coming from a business owner point of view, I would say most of the commentary is quite negative around it in a particular way. But if you're reading the general narrative of the whole budget side of thing, was essentially like a bit of an equalization of it all, and you can do what you want with that and read what you want with it into it all. But simplistically, it's about basically getting the fair share up front, so to speak, in the government's eyes. That they're taking the clip up front, so to speak. So, like Ange was touching on there, it could just be the way that you the way that the payments work. So there could be up to certain points and then moving on from there. And I think the reality is that everything is digital, everything is online, everything is accessible in regards to be able to really easy. If your numbers are up to date, as in say numbers are up to date today, it gives you a clear picture of exactly where you sit as a business, where you sit as a company. Like you can't hide anything anymore. You can't it's very, very hard to do it all because it all lines up, all your bank accounts, all your accounting, everything, it all feeds into the same location. So it's all very, very visible as well.
Yep. It makes your accountant's life so much easier when they're trying to advise you on things too. So,
Pros and cons to both. So was there anything else out of the budget that you sort of saw?
Just touching on EV cars. Business, it's probably worthwhile if people have been thinking about buying EV cars in businesses. It's actually really beneficial for FBT exemptions. So, jump on that bandwagon if it's something you've been thinking about. It's also, I think, with people doing solar and that, it's a good brand promotion for their business because I know it's not as practical as a tradie car should be. But yeah, just something there that's going to end 1st of April 2025. There's going to be a little bit of a discount going on. So yeah, you've got a bit of time there to explore that option. And just quickly as well, there's loss carried back, carried forward, carried back, however, I don't know.
However you want to be,
you can flip between financial years to get some tax back. So if a company does come out at a loss, it's not, yes, you'll get refunded back the PYG you've already paid, but you could potentially get back some of last year's money you've paid too. So that is definitely going to help. And I think that bolsters into, if you're in a growth period of the business, you shouldn't be too scared to make that loss now, because they'll be
You carry it
rewarded.
forward.
Yeah. Not that we want to encourage people to be at losses, but there's a little bit of relief there if it does happen.
Different seasons for different businesses.
Yeah. Yeah.
Then obviously we did touch on it already, but I will bring it up again. There is the instant asset write-off, obviously, which permanently increased to the $20,000. So that's there for good now.
If you need any tools or anything, go buy it before 30 June.
And I think on that too, we probably didn't touch on that too much around with your, we sort of touched on it a bit there, but probably it makes it really black and white. So like if you're looking to potentially minimize a bit of the tax that you're paying and you have surplus dollars there, that if you go and spend that money, you get it back basically straight away. Like you're able to write it off immediately. So say you need to go buy, a $10,000 piece of equipment or something like that, that you can do that. So you spend the $10,000, but you get the benefit of it also on a tax side of things instantly.
In that year, yeah. Because if you went out and bought stuff in July, you've got to wait a whole tax return lodgement to get the benefit of it. So yeah, June's pretty much a good real deadline if you've been thinking about. I'm not encouraging people to go out and buy things that they don't need, just to minimize.
Yep.
If there's something that has been on your radar for a while and you got the cash, then yes, by all means, now's the time to go do that.
Cool. Anything else out of the budget that you want to bring up, Andrew, or has that pretty much covered it?
I think that's pretty much it. I think capital gains are negative of the year. That's been done to death. There's not, I guess,
no.
Yeah, there's lots of resources out there you can go look at. But from a business point of view, the trusts are going to be the front and center in our world anyway. We'll just sit and wait for any further announcements at this stage. So yes, again, nobody panic. No one go restructure tomorrow. So we'll just have to wait and see what happens.
Yeah, who knows what it holds. But yeah, obviously just bring awareness to it. Make sure you're aware of what is and isn't happening. And I think it's a really good opportunity, like I touched on before, just become aware of how and why your business is the way it is in regards to the structure of it all, and just get a really clear understanding of it all. It will help you make better decisions, in the future, but also B, with these changes that have occurred, if changes do need to be made, it will just give you a more, a more informed ability to make the decision without sort of just not going blindly at it. But I think we would probably all agree when everyone first started, it was just like, whatever the accountant said, basically. And we just ran with that because we didn't have the knowledge or the understanding around it. So, but knowledge is power around it all. I think it also too gives you the ability to be able to then have a look at ways that it will work for you. The more informed and the more educated you become around the structure, you may then be able to put forward ideas around, hey, this is what I'm doing. Because I think also too, at the end of the day, you got to understand that your accountant who you're dealing with is not a mind reader either. So if you've got all these ideas, all these thoughts, if you are a bit more informed, it gives you the ability to put a bit more thought into the potential ideas that you have happening in the future, or things that you might want to be doing with the business, and you can bring them to the table with a point of view of why you want to be doing it or why you want it to be working. And then it can be a conversation that is not just an idea, sort of like a paper plane thrown in the air and it lands where it lands. It sort of gives you the ability to have an informed conversation with your accountant and come up with the best strategy for yourself and your business and your family long term. So
yes, don't be afraid to call your accountant and talk through any ideas. That's what they're there for. That's what we love too, because then we know more about your business, more about your personal life, so then we can advise you. So
love it.
Yes, pick up the phone, have a chat.
So there's a couple of things, obviously, if we're putting a little bit of a bow on it all, to take into consideration. Obviously, end of financial year. Hey, how can I have a look at minimizing as such, or paying the required amount rather than overs in a tax point of view. What am I looking at trying to achieve? Am I trying to achieve that minimizing it, or am I actually looking at funding or financing in the future? Get on the front foot now. It's 6 weeks away basically until the end of the financial year. Speak to your broker, speak to whoever you need to speak to around the financing side of it all to get a structure in place around it. So you've got an idea so you can have an informed decision-making ability, because like we touched on, some things have to be done before June 30. So you can't retrospectively do it because it'll just fall into the next year. The other thing around that is obviously we've got our payday super coming into it in the new financial year. So coming July 1. And then obviously a couple of things we touched on around the budget changes that are potential. They're not in yet. Just want to obviously make that known, but to be aware of it all. And last thing I want to sort of just close on is obviously July 30 ticks over. So July 1 ticks over from June 30. I've got my calendar right there in my head finally. Just be aware that your apprenticeship wages will be going up at a minimum. There's a chance that you may also have other rises in pay depending on how your structure is and what you got set up. But at a minimum, you need to be aware of what your apprentices are being paid. They will get an increase. That should come out within the next couple of weeks. It generally drops about the first week of June. So that'll come out. So there will be an increase for them. That'll be passed on immediately for July 1. So just make sure that you get on top of that, are aware of it, and make the changes so that you don't have anything to backdate. Obviously on that as well, just check everything that you've done for this financial year. And if there is anything that needs to be, if you have missed someone going from a third year to a fourth year or something like that, that you've upped that and you've backdated it to be able to pay anything. Generally speaking, it's quite minuscule in the scheme of things, that the actual dollar value, but just want to put yourself beyond reproach there because if it does go pear-shaped, it ends badly if you seen as doing it deliberately. And again, you'll bear the brunt of it yourself. So that's probably about it in regards to the snapshot of things to take into account for moving forward to the financial year. So Ange, as always, thank you very much for joining me today. Appreciate it for your time, and thank you.
Thanks for having me.
No worries at all. Thanks for listening, everyone. Whatever you're up to, whatever you're doing, enjoy the rest of your day. Cheers.
Bye.
That's a wrap on another podcast. Whatever you're doing, don't be too busy to stop and check if you're making money. And above all else, you know the rules. Be kind. See you soon.